So I know that every week I say, "Oh, this is the best Desert Pencil webinar ever," and they are all great. They are, but this one's great and a little bit different because in this webinar I invited one of my personal money guys, financial planner Nick Bedlin, to join us to talk to the group about the basics of financial planning. Having a plan, working with a third-party advisor, which type of advisor, some things about stocks, some things about mutual funds, things about retirement, helping children get started investing. This is going to be a really great talk. It's going to be about an hour. If you haven't done this stuff before, this is the webinar for you. Anyway, we're not here to talk about that today because we have a very special, cool, good friend of mine, Nick Bedlin from Creative Planning, as promised. Nick is a financial planner. He is a well-educated financial planner. He understands the HP 10B2. That's why I just went, okay, you're my guy. Just sign me up. As soon as he brought out his 10B2, I go, you must be cool. And Nick is one of the guys that I trust about money. And I feel very, honored, I'll use that word, that he decided to show up today and join us and share what he has to say. We talked a little bit yesterday, and I don't bring a lot of people into this thing, as you guys know. But what I told Nick was, this is not a commercial for your services. He will talk about them a little bit. That's part of the gig. But what I told him was I want him to show up and bring some things that are important that you guys can learn from. And so, his slot is about 20 minutes, give or take. And after that, he is available for the rest of the hour for questions and answers. All right. So let's welcome Nick.
Thank you, Joe. Morning, everybody.
Morning. Hi, Nick.
Morning, Nick.
Morning. Yeah, glad to be here, and such a neat vibe we have going here. So I could tell you guys all, have been doing this a while, and love Joe. Really respect everything he does. So I'm honored as well to be here. And just to reiterate, I have to do the disclaimer. Yeah, just read this little thing. Compliance. This commentary is not. This is for general informational purposes only. To be construed as investment, tax, or legal advice. Past performance of any market results is no assurance of future performance. All right, that's done.
Okay, before you move forward, I just want to interject. Would it be interesting in the real estate industry if we were required to say that before we pitched a client? Wouldn't that be interesting? Anyway, go ahead.
Really?
Totally. So yeah, I want this to be interactive, so I'll probably present for 10 or 15 minutes, but the real fun part is taking questions at the end so that we can take this whatever direction you want. I'm going to cover some investment education, investments 101, also some retirement planning stuff. We're going to talk about Social Security, some taxes, and lots of stuff. So first off, quick story. I've been doing this 23 years. I've kind of seen it all within my industry, and it's frankly the wealth management industry, financial advising. I would give it an F. We're about as good as the healthcare industry, and the reason I say that is everything is fragmented. So you meet with your doctor, they say, hey, go see this specialist. You go across the street, you start completely over with that specialist, fill out the same paperwork. The insurance issue, but advice is given in silos. And I think in the financial industry, it's the same thing. You meet with your accountant every year. They just want to know what you did, send me all your stuff. I'll help prepare your return. Or you meet with an estate attorney every few years. But no, they're not talking to the attorney. They're not talking to your investment manager. So it's very fragmented. And so creative planning exists to try to change that. So if you're familiar with how the Mayo Clinic does it or Cleveland Clinic, our model is the wealth manager is which is what I do, is your one point of contact. And then we have all the specialists in-house, attorneys, CPAs, et cetera. The reason I say that is because I've also seen different models. So I promise I'll get into the meat of this, but I do, Joe's comment about real estate. I wanted to kind of tag on to that because there are a lot of different ways to work with a quote advisor. So there are insurance companies, right? Your State Farm agent can sell you mutual funds. I mean, you can walk into a bank and there's someone sitting in the bank lobby that can sell you investments. And so one of the things I'll talk about later this morning is fiduciary versus broker. So in our industry, in my industry, a fiduciary does not work on commission. And that's, if you are going to work with an advisor, it doesn't have to be creative planning, but ask them that question. Are you a fiduciary? Because that is a different legal standard. So it means that it sounds obvious, but you have to act in the best interests of your clients 100% of the time. And we're one of the only countries in the world that where most advisors are not fiduciaries. So so if you're not a fiduciary, it's what's known as a broker, and that is what's known as the suitability standard. So something to be suitable is a much lower bar than act in best interest. So that's just point number one, is you want to work with a fiduciary. So but a quick story. So Joe asked me to kind of start with maybe a client success story. So I'm originally from Omaha, Nebraska, or the Midwest, and about 15 years ago, I met a client. She was an ER doc, making really good money, probably in her early to mid 30s at the time. And so we sit down to go over her financial plan and everything, and she had no money. I said, "What's going on here?" So, and I noticed when she came to the office, she came, and this is 15 years ago, rolled up in a Range Rover, like $100,000 car, had no money in the bank, credit card debt, etc. And so we basically just took everything and threw it out on the table. And her point was, I work really hard. I know I'm going to get raises. I'll figure it out later. Basically, sometimes people think that just I'm going to make so much money later, I'll worry about it later. So at the time, we were able to scrape together about $25,000 for her to start an account. So this is probably 2013, 2014. I helped her organize all her finances. We got her insurance in order. She had been sold a bunch of cash value life insurance. That's we can talk about that if you want, but it's not an investment. Anyways, got everything organized, got her investing systematic or automatic. And fast forward to I just met with her last week. We did a portfolio review, and her portfolio with us is now at $2.5 million. She's now about 45 years old, and she's on track to retire, somewhere between 50 and 55. So I know it's more fun to talk about what's the hottest stock, or should I buy Bitcoin, or all these things, but before you do anything on investing, it's really important to have a 30,000 foot view of your situation and have a written financial plan. And you've probably all heard of that famous study in the 50s of the Harvard grads, the ones that wrote down their goals versus the ones that didn't. I mean, it's night and day difference. And so it's not good enough to just say, hey, I'm going to save, do the best I can and save when I can. You want to write it down and map it out. And there's tons of software out there to do it. It doesn't have to be fancy. Joe's a big spreadsheet guy. There's ways to do it in a spreadsheet, but that's really important. So just remember that it's never too late as well to make those behavioral changes and get things set up. So the other thing Joe asked me to do is try to keep the charts light, but I'm an analytical guy. So take a step back. I'm a certified financial planner, and I'm also a chartered financial analyst. And chartered financial analyst is sort of that's the hardest designation in my industry. It takes about 3 to 5 years to get. And so that's where I got my 10b5-1 skills from. So, but anyways, yeah, I've never met a chart that I didn't like, but I promise all of these charts will be educational and informative. So I'm going to share my screen here. You're going to see beautiful Mount Rainier to start. All right. And
are you able to share? Okay, there it is.
Yeah, there we go. So feel free, by the way, after the meeting, if you have any other follow-up questions, this is my email address, and Joe has it as well, but it's nick.bedlin@creativeplanning.com. So,
hey, Nick, can you just throw that in the chat for everybody?
Yes, let's see here.
Since you've got that right up there, you can just copy that and probably paste it into the chat.
Is it because I'm sharing, it's not showing me the chat option? Let's see.
I don't know.
I'll do it. Don't worry about it.
Okay,
You just
sorry
keep
about
going.
Yeah, if you could throw that in there, that'd be great.
Yeah, I'll do it.
All right, so I apologize. I'm gonna fly around here, but just raise your hand or feel free to ask questions as we go through here. Um, so first slide here, I want to talk about is diversification, and everyone. Sorry here. So everyone's heard of the S&P 500, but not everyone understands kind of how it works. So I just kind of wanted to start with a simple concept that if you put $1,000 into Vanguard or iShares, there's a lot of different versions. They're all low cost. They're great. Into the S&P 500, and this was 2022 at the time, but Apple is about 6% of the S&P 500 at the time. So if you put $1,000 in there, you're going to get about $60 worth of Apple and all the other stocks. Now currently it's Nvidia and Microsoft, and the reason you hear about indexing, or a lot of us think, what's the best stock to buy, or these are my favorite 10 stocks or whatever. But if you flip it on its head, with the risk with that, if you say I'm only going to buy my favorite 10 or 20 stocks, it's not that did I buy the right stocks, it's what didn't I buy that I'm missing. And so a great example is Nvidia. If you guys have all heard of Nvidia, it's the whole AI play, and it's really been phenomenal, obviously. But this kind of blew me away that in 2024, if you did not own if you took Nvidia out of the S&P 500, the index only returned 2.6%. But last year the S&P was up 25% by removing one stock. Look at that rate of return. And so you've ever heard the needle in the haystack story? We're all trying to find that needle in the haystack, that next Nvidia. And the point is, just buy the haystack. You're guaranteed to get a great return. And so I just think that's a phenomenal chart as far as a reminder of the benefits of casting that wide net is you're going to catch the Netflix, the Tesla, the Nvidia. Because as a financial analyst, some of the biggest winners that have ever come out of the stock market, a financial analyst never would have bought them because the numbers didn't make sense. Tesla's numbers have never made sense, but it's been one of the best stocks of all time. I mean, so point being is if you just buy the haystack, you're automatically going to catch these generational companies. And then Joe's going to love this one. Sorry. And I think Joe has shared an example like this with you guys before. So, and Joe, we did not put your name on here. This is just how Creative Planning does this slide. But so a 20-year-old, Joe's 20. He contributes $3,000 a year until age 30. So 10 years. He invests 30 grand. Earns a 7% return. At age 65, that's $473,000. Steven waits till he's 40, contributes double, $6,000 a year. So total investment, $150,000. So 5 times as much money that had to go in, and still had less at age 65. It's just amazing to me how much, the earlier you start, how little you need to save. There's another, you've heard the Einstein quote, compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. And there's there's another one later on here, this one right here. So if this slide, what you're looking at is how do I get $1 million by age 65? So a 25-year-old would only have to save $381 a month to have $1 million at age 65. A 35-year-old would have to save about $800 a month. A 45-year-old is about $2,000 a month, and a 55-year-old you'd have to save like $5,000 a month. So it's just another example of that time value money and the benefits of starting early. It's pretty remarkable. And then the other thing I wanted to share, I'm sorry, I'm jumping all over because there's just so many different concepts here. Let's see, 29. So I'm going to pause here on investments and zoom out a bit because, as I mentioned earlier, the first step before you invest is to get your house in order. So if you think about a garage, you have this stuff everywhere in your garage. You can't even park the car. You don't even know where to start. It sometimes feels that way in your financial life. You have bank accounts at 4 different banks, you have an online savings account, you have a 401k that from an old employer that you haven't really touched or looked at in a long time, or a Roth IRA that you haven't logged in for 3 years, or a credit card where you're just making the minimum payment on auto pay, and just all these different things. So step one is just to get it all out there and start with a net worth statement. So that's a listing of all your assets. We like to categorize them in different areas like bank accounts, retirement accounts, real estate, personal property, business assets, etc. And the first thing I like to say is, which one of these assets are bringing money to me, and which of these assets are taking money from me? And so typically, for example, personal property, the cars depreciate, boats depreciate. So you kind of, when you add up all your assets, you want to minimize that piece of the pie. So hopefully, 80-90% of the assets on your balance sheet are somehow bringing money to you. Now, real estate's an interesting one. I mean, invest in real estate all day long, but resident, the house you live in, let's be honest, it's kind of a break even, right? I mean, it does appreciate, especially in this area, but it's not exactly sending you a check every month. So kind of when you think about it, it's things that produce income, it's businesses, it's investment property, it's retirement accounts, it's stocks. And then on the debt side, we're not Dave Ramsey. I mean, there's smart ways to use debt. Particularly, we kind of, in hindsight, we went through a pretty amazing era, from 2008 through about 2022. We lived in this kind of 2 to 3% world where you could take out a 30-year mortgage at, 3%, or in some cases less. That's an amazing inflation hedge. You guys are in real estate. I mean, I think the 30-year mortgage, Warren Buffett calls it his most favorite financial instrument, because on a 30-year mortgage, you get, if you lock in your housing, you lock in your costs, right? And everything goes up, and everything else in our lives goes up, right? Groceries, gas, etc. But your lodging, you get to lock in for life. Now, and property taxes, insurance, that stuff goes up, but that mortgage payment never changes. That's an amazing tool. Sometimes I tell my clients, imagine you found your dream home, but it was a rental, and the landlord said, look, I'll lease this place to you for 30 years and I'll never raise the rent. And at the end of the 30 years, you can keep it. I mean, that's a pretty good deal. And what Buffett says about it is, if you're right, you get to keep it forever. Meaning, if rates go up from when you get it, you get to keep it forever. If you're wrong and rates go down, you get to reset it. You can refinance. So a 30-year mortgage is a phenomenal tool. So step one in financial planning is just this simple net worth statement, assets and liabilities. And then from there, we know, again, there's lots of different software out there, but you want to have a target retirement age and look at your various income sources during retirement. So that'd be Social Security, maybe you have rental income and stuff like that, and everything else has to come from your portfolio. And so if you kind of look at a timeline here and the way our software looks at it, this was a typical retiree, John and Jane, in their 60s, and we map everything to age 100. And so the blue in this example would be Social Security, the kind of the light green is rental income. And so we say, look, then the yellow, everything in yellow has to come from your savings, from your investments. And so there's a way to basically calculate what's known as a magic number. In other words, every single person has a magic number. How much money do I need on day one of retirement to stop working or stop investing or whatever? So we work with our clients.
Hey, Nick, can you stop there for just 1 second? Yeah. Can go back to that previous slide. I just want to kind of jump in. So please. I think I've told you guys this before, but I am a client of Nick's. And 3 days ago, I did this chart with he and his partner, Josh. We did a Zoom call. And I just want to kind of say from the client's perspective, and you guys know me, I talk about money all the time. But to sit down with a third party, with other people, and have them kind of like diagnose your situation and go, you can blab all day long to the world all you want, but here's your situation. It was cool, and part of what's cool is because I have enough, and that's a nice place to be. But it's a very, very instructive exercise to go through exactly what you're seeing right now. And I have some comments when Nick's done here in a few minutes, but one I would just want to kind of throw on the table right now, that 30,000 foot view, that larger view of my life and how money plays in my life from where I am right now until I think I'm not going to be here anymore. That's the conversation for people in our, generally our age group, people that show up on this call, generally 40 to 70 or whatever we are. That I think that's the point of view. And Nick, if I'm wrong, let me know. But I mean, saying here's where I am now, and here's the rest of the run. What's my money going to do for me? And a lot of people don't get the opportunity to do that. It's a very instructive thing to do. I'm saying that as a client. That's all.
Thanks, Joe. Yeah, and I think, again, back to my industry, in a broker world, stockbroker, that's an old term, but when I worked for the Wall Street firms, I worked for Merrill Lynch, I worked for Morgan Stanley, we were trained to pick stocks and talk to clients about stocks and investments, and we never really went here. And my point is that rental income is a phenomenal thing. My clients who have mailbox money, Social Security, and rental income are not nearly as stressed out about the stock market as some of my clients who don't have a property or don't have any of that mailbox money. And so we do think that that it's important to look at the whole picture instead of just, what rate of return can I get? So yeah, it's there, and you can. The nice thing too is these tools allow you to do scenario analysis. What if I retire at 65? What if I retire at 63? What if I buy this vacation home, and pull that money out of the portfolio? What does that do to this timeline? So yeah, Joe's mentioned the HB calculator. It's at the end of the day, that's what the software is. But the point is before you ever think about what stock to buy or what fund to buy, this is an important first step. So the other thing we all think about is, well, it's uncertain right now. I'm just going to sit in cash until things, blow over. And cash feels very safe. And so the top of this chart is what we see. So it's right? We can never lose money in cash. I buy a CD. I put my money in a savings account. I can never lose. And this is basically how much income you would earn on a $100,000 1-year CD. So this is 1-year CD, how much income since 2010. So every single year you make money on that CD, right? Well, the bottom part of this chart is, well, you have to pay taxes on that CD, number one, on the interest. And number two, there's inflation. So after you factor in taxes and inflation, buying 1-year CDs since 2010, you would have lost money every year except for one. And then 2022, that was where inflation was really bad. But we don't see that, right? We don't see the taxes. We don't think about the taxes. We don't think about inflation. So it's just a good reminder that cash feels nice and warm and cozy and safe, but it's an illusion after you factor in taxes and insurance.
Can I ask a quick question?
Yeah, of course.
Just when you're looking at these CDs and what interest rate are you calculating on the losses? If we were to invest that money, are you figuring a 7%, 10%? What are you figuring?
Yeah, great question, Christine. So long term, if you're in the S&P 500, 100% stock has done about 10% per year. In fact, I have a Vanguard schedule or a table here handy. So this is since 1926, and so stocks have done about 10% a year. For our financial plan that I just showed you, we usually use 6 or 7%. Because a lot of clients who are close to retirement or near retirement aren't going to be 100% stock. So something that's 60-40, 60% stock, 40% bonds has done 8. So we sure want to do 8 to 10% or do the best we can. But for your financial plan, you should use a more modest rate of return just in case it doesn't materialize. So, but back to this chart, what it's really showing is it's showing like a negative 4.5% return because inflation in 2022 was over 9%. So a CD paying, let's say, I don't know if it was exactly like 5%, let's say, you're going to lose a little bit of that to taxes. So now you're down to 4, and then you subtract the 9% inflation, and that gets you to the negative 4.5%. Does that make sense?
I'm sorry, it doesn't,
Yeah.
but I'll try and. Joe, can you make a note and maybe go into that? And
Dad, can you explain that to me later? Let me give you just my quick opinion. it's not, there's nothing wrong with having cash. Okay. It's always a question of how much and how much do you need? You know, I mean, that's the thing. What Nick's saying is, you know, and any, I think, money guy worth their salt will tell you that cash is not an investment. It's just a parking spot. And what happens when you take into account the affect of taxes and inflation is that net you're losing money. So, you know, you got to have some cash. It's just a question of how much. That's what I would say.
Yeah, the other maybe this. So if inflation is 9% like it was that year, and you had $1,000 in the bank, at the end of the year you log in, you still have $1,000 in the bank, but it's only worth $910. I mean, you know,
Yeah.
9% inflation. You know, you don't see that it's worth 910, but it still says 1,000, but it only buys 910 worth of stuff. So we want to. The point is, we want to do better than inflation. That's why you would do stocks or other things that are going to give you a higher rate of return. So apologize jumping around here. I'm going to go to a different concept here, which is sometimes people say, well, I'm just going to buy Apple, Amazon, Google. These companies dominate. I'm just going to buy those and call it a day. And this is a good reminder of how creative destruction, how much things change. In the 1960s, AT&T was the largest company in the world. You know, AT&T, General Motors, DuPont, Standard Oil, which is, you know, Rockefeller, GE. You know, and then 1980, IBM was king of the hill, 80s and 90s. ExxonMobil starts to bubble up here. 2000, Jack Welch was king of the hill, and their GE's conglomerate was the thing to be in. And I guess that my point is, if someone had just bought IBM in 1990 and said that this is all I need, that you did not do well. So this is another argument of buying the haystack, because if you invest in index funds like the S&P 500, it does this for you automatically. So you don't have to do a thing. Someone could buy the S&P 500 in 1970, and you would have gotten General Motors, etc. And if you never sold a share today, your portfolio would be dominated with Microsoft, Apple, Amazon, Alphabet, which is now Google, etc. So it's the point of the winners. When you buy the haystack, when you buy an index, remember, a loser can only lose 100%. So if a company goes broke, you lose 100% of your money. The winners go up tens of thousands of percent. So it only takes a handful of big winners to erase any of the losers. So an index fund automatically puts more money with the companies who are winning, and it's selling off the companies that are losing. So IBM over the last 30 years has become a smaller and smaller part of the S&P 500, where Microsoft's become a bigger and bigger part. So it's I hope that makes sense, but it's just buy the haystack and it'll do this for you.
That's an excellent point.
Um,
Okay, what else you got, Nick?
let's see here. Let's see. I want to show you page 31. So this is another one of my pet peeves. You hear it, oh, the stock market is a casino. If it is a casino, that's the casino you want to be playing in. So the odds of winning various casino games, you know, roulette 40%, slots 40%. A good craps player can almost get to 50% odds, but you're still gonna, you know, basically break even. And God bless someone who plays Keno, but if you have a 23% chance of winning, the terrible odds. So those are terrible odds. All of these are coin flip at best. This is the odds of making money in the stock market, and I'm showing you the S&P 500. Any 1 year period, you have about a 72% chance. In other words, 3 out of every 4 years, the market's going to be up. 1 out of every 4 years, it's probably going to be down a little bit. But you extend that out to, if you stay invested for 3 years, 5 years, 10 years, again, remember, a casino is 50-50 at best. So if I could go to Vegas and they told me I have a 92% chance of winning or 86%, sign me up. So I just don't let anyone tell you that it's now you can turn the stock market into a casino if you're day trading, if you're going on to Robinhood and trying to buy and sell, then you are sort of playing roulette. You are playing those games. If you buy an index fund, it's like you're the owner of the casino looking down and watching the other people lose their money, but you're just sitting back winning. So that's the idea of owning index funds. Let the odds be in your favor. Let's see, 36. Just reminder, the media has a fiduciary duty, and it's not to you and I. Their fiduciary duty is to shareholders. How do they make their shareholders happy? Profits. How do they make profits? Sell advertising. How do they sell advertising? Breaking news, urgent, crisis, like all these different things that try to scare the viewers, but it's mainly just to get eyeballs, which then again gets advertisers. And these are just a couple examples. Like in 1994, there was all these headlines about the Mexican government and the peso, and it just shows that it's just showing that all these crises, if you just had invested during, you made money every single time. The point of this slide is don't let the media scare you about the market or about investing. During April, right? The Liberation Day and all the tariffs and the market just started free falling. And compliment to Joe, we had in the middle of April, we had a great meeting, and he was, cool as a cucumber, and he said, yeah, should I put some more in right now? I said, absolutely. And we did that. And I didn't think it would turn around as fast as it did. But the point being is this is another Warren Buffett quote. They asked him, what is your secret? And he said, when the masses are fearful, be greedy. When the masses are greedy, be fearful. So in April, everyone was very, very fearful. So there's fear baked into those prices that you could take advantage of. And sometimes, like 1999 tech bubble, there's been certain times in history where everybody was, cab drivers were buying tech stocks, and like there's times when the masses are being greedy, and that's the time to maybe pull back a little bit. So in other words, do the opposite of the crowd in general. This is why some people say, why does the stock market go up? This is probably the simplest way to explain it, is the price of what they sell goes up. So if McDonald's can charge more for a hamburger, they're going to make more profit, and then their stock is going to go up. Or price of a Hershey bar. Fun fact, an ounce of chocolate has outpaced an ounce of gold in the last 50 to 100 years. So that's a pretty good business. They take some chocolate, put a premium on it, and sell things. So,
Chocolate went up a bunch last year.
yeah, there's a big cocoa.
Yeah, the cocoa thing. Yeah, exactly. So, hey Nick, can I pause there for a second, because we have about 20 minutes left,
Okay.
and I want to make sure we have enough room for people's questions and answers.
Perfect.
So let's just pause there. Does anybody have anything they just want to throw in right now?
We want to say,
Yeah, I'd like that.
go ahead, Jock.
Okay, when you started, you identified yourself as a fiduciary. My understanding is, as a client, when I come in or talk to you, I should always ask, are you a fiduciary? And some people get hard-nosed and say, will you put it in writing? But then the second thing that I see or read as whatever is to ask you, how are you paid? And without specifics or whatever, can you give us some idea of how Joe pays you or how your firm is paid?
I'll answer that.
Go ahead, Joe.
He gets a percent of the money that I've invested with him.
So it's AUM, assets
Yes, sir.
under management.
Correct.
Which is a common model for, at least in
Right.
my experience, for that kind of thing. The other thing too about Nick is Nick gives me access to certain things that I can't just get on my own. That's how their industry is built. But at the end of the day, here's how I look at it as a client. If he can do better than I can do on my own, net of fees, why wouldn't I? And he does.
Yeah, and if you think about it, you want incentives drive behavior, right? So, and by the way, what Joe pays to the creative planning doesn't all go to me. We have attorneys account. We have a lot of other people, and this idea of sharing these experts with other clients is a great concept. But if you think about it, if Nick Bedlin or creative planning wants to make more money, the only way we make more money is if you make more money. If your portfolio goes down, our income goes down. So talk about motivation to do the right thing, we can't control the markets, we can't predict the future, but we are certainly motivated for your account to go up, because that's the only way our income goes up. We're on the same side of the table.
Is it possible for people to come in to be clients, access less, maybe just like okay, I've got this and this and this and this done, and I would like to work on this specific project, or specific part of my financial situation. Is it possible to do that sort of thing? Or when you sign in, are you buying the whole pie?
Yeah, good question, Jack. So first off, it's not all or none. So we're not a firm that says, hey, unless we're managing all of your money, we won't work with you. We're not that at all. So you may say, hey, I do have this account that I like to manage myself, but I want you to help me with this account. Now, I will say though, as long we still would want to do the full 30,000 foot view, because those other accounts, even if we're not managing them, impact your long-term financial plan. But I think what you're asking, Jack, is do we do project-based advisory?
Exactly.
And so my firm does not, but there are a lot of firms that do. If you find a certified financial planner, a lot of them will do an hourly project or a flat fee
Right.
for a certain assignment. So that absolutely exists. But again, incentives drive behavior. I'll just say that most of the more qualified / talented advisors won't work under that model because it's hard to make a good living doing that, to be frank. So just make sure they're a certified financial planner, but most of the more experienced advisors don't really do that model.
Okay, thank you.
Yep.
Coin. What's your opinion on Bitcoin?
It is so my opinion is no opinion, and I don't mean that facetiously. I just mean that just like Joe has taught you guys likely to value a rental property and putting in, okay, here's how much income I'm getting from it. So in other words, if you have something that produces income, you can put a value on it. Bitcoin is like gold. It doesn't produce anything. It doesn't pay any income. So it's worth whatever people are willing to pay for it. So I guess I would just put it more in that speculation bucket. But but is it could you put 1 or 2% of your money into it? Absolutely. So if a client comes to us and says, I want some Bitcoin, we'll buy it for them, but we're not going to stand behind it and say, yeah, this is proven, this is going to work. But it's sure having its day in the sun right now because there's all this concern about different government policies around the world, the dollar's losing value, this and that, and so it's definitely tailor-made for this situation. There is no government influence, blah blah blah. But I would just say be careful. Maybe put a little bit if you want to try it out. But it's still my take on it is until I see it change our everyday lives. It's hard to imagine that it's going to really be mainstream. But we'll see.
That was kind of because gold, silver, I mean, 10, 15 years ago, it was buy gold, buy silver, buy, and I understand that having that in my safe compared to owning shares in it with, or whatever they're called with other companies.
Yeah.
I know a lot of people did that too. You bought into gold or you bought into silver, kind of like buying into oil, I'm assuming.
So those are what I'd call store of value. It's much better to, buy some gold coins, put it in a safe than if you just took $1,000 of cash and buried it in the backyard. 10, 20, 30 years later, you could dig up that $1,000 cash, but it's not going to buy what it used to. The gold probably would. But what it doesn't do is beat inflation, in our opinion. You're not really getting ahead. So you're keeping pace with inflation. And again, you can't eat it, right? It doesn't produce any cash that buys you food and shelter, et cetera. So it doesn't produce anything. So farmland produces a crop, you can sell it. An apartment house pays you rent, a stock pays dividends, a bond pays interest, gold pays you nothing, Bitcoin pays you nothing.
Let me just jump in on that because that's a good thing for me to go back to a little bit of desert pencil speak that we have talked about. And I say this all the time: appreciation, cash flow, combination of the two, right? The three pillars. So Bitcoin and gold, precious metals, are not going to provide cash flow. They are an appreciation play. That's why you buy them, because you believe I buy this today, it'll be worth more in the future. The backdrop of metals and I think I would say Bitcoin for me is in the same bucket. And Nick, you disagree, let me know. But it's a play on scarcity. Okay. The key feature of Bitcoin is there's a finite supply, and that's why it keeps going up. Okay. Now, without getting too macroeconomic-ish on you, we've talked about this a little bit in past webinars. You know, right now the dollar is it's the world's reserve currency, and that's a thing. But in a geopolitical world, our competitors don't want to see that happen anymore, and we should be very mindful of that. And so when we see this turmoil geopolitically, and as Nick said, you know, the dollar falling in value because of that, or the perception of the value, you see an inverse relationship with Bitcoin and precious metals and that kind of thing. Okay. In an overall portfolio, you know, I would never say, oh, just go all in on Bitcoin. You know, I saw a thing a couple weeks ago, like they picked like May 4th or May 8th. Every year it's gone up in value. Okay, that's appreciation. Okay, it's also taken huge dips down, right? So I'm on board with Nick. I think some is okay, but understand what it is and what it's not. It's not going to pay you anything. It's an appreciation play. And if you want to go buy gold, my suggestion is go to Costco. That's where I bought all mine, you know, and they sell gold, silver, and platinum. So if you want to get into metals, that's the way to do it. When they have it, it sells out pretty quickly.
Yeah.
Okay, we have
two
about.
other- Go ahead.
Go ahead, Nick.
I was going to say just two quick comments on Bitcoin. Number one, there is a risk that quantum computing, they're saying that there are going to be computers powerful enough to hack those wallets. So that's another reason not to put all your money into it. And number two, Joe's right. There is a limited supply of Bitcoin based on the blockchain and the rules of it, but there's an unlimited supply of cryptocurrencies. So
Right.
if you kind of think about it, there's tens of thousands of them. So
Yeah, because once you lose your wallet, you lose everything, right?
Yeah,
That's
right.
the thing.
Yeah.
Okay. We have about 15 minutes left. Who else has a question for Mr. Bedlin?
Please, I want to ask a question.
Please.
Yes, Matthew.
I would like to know, are there differences between creative planning and Raymond James, Vanguard, and all these other financial planning companies? Thank you.
Yes, Matthew. So the first decision tree, is it a fiduciary or a broker? And there's an easy way to determine that very quickly. You go to the home page of the organization, and if at the bottom of the page it'll say securities offered through SIPC, and that means they're a broker. So in other words, if they securities offer through blank blank blank, that means they're a broker. Now some of these brokerage firms like Raymond James, so the reason I'm bringing that up is they would say they're independent. Raymond James advisors are independent, but there's independent brokers and there's independent fiduciaries. So just there's a difference. And then there's full service, which is where the world I live in, and then there's DIY, so to speak. So Vanguard is more like a DIY that they're lower fees, but you have to do more of the heavy lifting. You have to make more of the decisions on your own. So there are so there's DIY to full service, and then there's fiduciary or broker differences there.
Nick, can
Thank
you hear
you.
me?
Go ahead, Sandy.
Hey, I've got young adults, 22 and 18, and I'm trying to share my wisdom with them to not make the mistakes that I've made, and would really like them to get started early in life saving, taking the advantage of compounding. How would I get them started? And do I just have them start saving in a savings account up to a certain point, and then move it to an investment account with you, or how does that get started?
Yeah, great question. So the first thing before investing, make sure they have no high interest credit card debt, because
Yep.
if they're paying 20% interest, there's no stock or S&P 500 that's going to keep up with that.
Yeah, they're
Second,
there.
yeah, and then then an emergency fund at that young age, maybe 3 months of their living expenses in a savings account that just doesn't go up and down with the market. So that if they have eliminated the high interest debt and they've got a 3 to 6 month, rainy day reserve, then investing makes a lot of sense. And the biggest advice I can give you is if they have earned income, to start a Roth IRA, because a Roth IRA, that money will never be taxed. The growth will go tax free. They can put 7,000 a year into a Roth right now, and a lot of the firms. And feel free to email me after the meeting, but there are firms like Vanguard, as Matthew mentioned, Charles Schwab, Vanguard, Fidelity. These firms all have very low fees, and you can set them up for automatic. Because the other biggest advice I can give you is make sure they automate it. Automate your savings. So if they can't afford that 7,000 a year, chop that into 12 monthly deposits and have it automatically go in. Again, I'm happy to talk to you individually, but that's Roth IRA would be the biggest advice, because they can actually use that money to buy a home. There's a few exceptions to tap that Roth before retirement. Does that help?
Very much so. Thank you.
Let me add one thing to that, because you guys have all seen the Desert Pencil retirement spreadsheet I built, desertpencil.com/retirement, free spreadsheet, just download it. But I was talking to a friend of mine who's in his mid-70s when I first wrote that spreadsheet, and we talked about it. The first thing he said was, yeah, try to get a guy who's 25 to think about something besides beer and girls. Okay? And I thought, he's right about that. So I think what I would add, Sandy, and anybody else who has children or grandchildren of this, early savings age, talk to them about future you. And that's I think it's so easy, like Nick said at the beginning with the doctor. Oh, I'm making money, I'll worry about it later. You're trying to break that mindset of worrying about it later and starting now, because of the extraordinary benefit, especially starting in your 20s, of compound interest. It is just the craziest thing. And go to desertpencil.com/retirement. Look at that spreadsheet, little video I built. It'll show you exactly what it is, and share it with your young people. That's why it's there.
Thank you, Joe.
Yep. Okay. Who else has got something? Chris, you got anything?
I don't.
Okay. Christine or Mercedes, go ahead. We haven't heard from you today.
So how do I evaluate high yield savings accounts? There's a bunch of stuff online. I don't know. I just don't know how to determine if it's some kind of, scam.
Yeah.
I mean, it's just something I've never done. I've always banked with like a big name, but I know I'm looking at my bank statement right now. I have way too much in stuff in cash.
Mhm.
And that's something I would really like to do, but I really don't know how to evaluate that piece.
Sure. So there are websites out there like NerdWallet and Bankrate.com that will show you the highest yields. And as long as it's FDIC insured, even if it's kind of a bank that you haven't heard of, it is safe. I just don't know how much you want to jump from place to place. So I typically say to pick one that's reputable and stick with it instead of jumping all over the place. I don't want to give a specific name, but if it's the big banks are usually pretty fair about it. But just remember too, an online savings account is still cash. Now you're making your cash.
Well, yeah, it's better cash.
Yeah. Yes, exactly. Yeah. Money markets too. Fidelity, Schwab, all these other brokerage firms. The money markets pay just as good as those online savings accounts. In some cases, better. And those money markets basically own treasury bills, so it's super safe as well.
And right now, Nick, we've talked about Value Advantage and the Schwab family of funds. Are we at the 4.25-ish median value right now?
Exactly. Yeah,
Okay.
4.2, I believe. Yep.
Yeah. Go ahead, Christine.
Okay. I want to know if paying off your mortgage, like before retirement, the financial person I've been talking to, we're looking at, how to make my payments in retirement, because cash isn't always king, like you were saying. So your opinion on, like, if I'm at a 3% right now on my mortgage, so I'm not putting anything extra on that. I'd rather put that into an investment fund, but kind of that overall all your payments and everything, making sure you have enough cash to live off of doesn't necessarily mean, you know,
Yeah. Yeah. That's a great question, Christine. A few thoughts. Number one, the simple one is, can my money earn more than the 3%? And so just there, you get a tax deduction. Not everybody, but most likely there might be a deduction. But let's just use 3%. So if you have investments earning more than 3, you're better off earning that spread. Second kind of thing I would think of it is if I were on the other side of the trade. So if someone said to you, I have this great investment, it's going to pay you 3% for 30 years, it will never go up. Would you buy that? Probably not, right? So we're winning that trade. So the bank would send you a thank you note to pay it off early. And I'm giving you I want to maximize my net worth strategy. So that's the hard numbers. But I tell all my clients there is the sleep at night strategy. It's not optimal on a spreadsheet, but some people just say, hey, if I'm debt free, I'm going to sleep better. So it depends on your goal. If it's maximize your net worth, keep the mortgage, you earn the spread. But if it's, hey, I don't want the debt, I don't want it, that's okay.
As somebody who just paid off his mortgage 2 days ago, I fall into that latter bucket.
Well,
Yeah.
You know, that is such an excellent point that Nick just made, because I get this question regularly. You know, because does it pencil voodoo and all that, and I can. But if I can just kind of summarize what Nick said, you know, if you can make more on the spread, that's called arbitrage, right? If you can invest 3 and make 5, you're 2 points ahead. Why not do that? But I've met a lot of people who just said, you know what? I just don't want the debt, period. I mean, there was a woman I still remember in Sun Valley in 2021. She has like a 2.75 3-point mortgage and like $180,000, $900,000 house. And she came into some inheritance money. And she's like, you know, should I pay off my mortgage? And I'm like, no, the stock market's going up 25% a year. Why would you do that? She paid off her mortgage. She's like, I just don't want to worry about it. Well, okay. It's not the same answer for everyone.
As someone who, and this is a few years ago, going into retirement, I didn't want that payment. So we doubled our monthly payments and whatever and paid it off. But then once that was done, then we were sticking more into our S&P 500 mutual fund to try to make up a little bit for maybe what we'd, the opportunity cost that we'd given up to get the mortgage paid off. So there's a way I never sat down and figured out if I caught up, but that was how we did it. We paid it off and then doubled up on our investing.
So we paid off our mortgage, but then when interest rates dropped so low, I pulled out all the equity I could without paying PMI because I have like I said, a 3%, and I knew I could make more money. So I bought a couple properties and invested into an account.
It's
because
like your own little
3%
1031
to me,
exchange. It's perfect.
yeah, well, 3% to me is free money.
Yeah.
So, that's almost like free money. So that's why I actually did the reverse, had it paid off and then borrowed because I wanted the interest.
And I adore your comment that it's free money is factually true. If inflation is 3% and your mortgage is 3%, then it's zero.
Hey, Nick, question. Kind of a vulnerable question because there's a couple work associates in my office on this call. But what would you advise if you don't feel that you're where you should be financially? And what are good methods to catch up and accelerate your savings towards retirement?
You bet, Sandy. You're not alone. I mean, I don't have the stat handy, but it's a big number of Americans that are behind the schedule on this. I would say
I'm going to throw in on this real quick because I wrote an article about it 2 weeks ago. About 70 to 80% of all retirees only have about 200 to 250,000 saved, and they need about at least 1 million more. So that statistic does exist. Go ahead.
Yes. Yeah, thanks, Joe. Yeah, so I would start with this, someone like me or someone that can help do that 30,000 foot view, because I guess step one is how far are you behind? And maybe you're not behind. Maybe you just feel like you're behind. But that would start with that 30,000 foot plan to say, here, what is that magic number? And then you back into it to say, how much would I have to save to get there? And if that's not possible, then we have to kind of reevaluate the goal side of things. So some clients come to me and say, I want to spend, I just need 5,000 a month in retirement. Great, no problem. Other clients say, I need 30,000 a month. It's like, I get it, but you don't, that's not possible. So, again, retiring in, I don't know, Las Vegas, Nevada is different than I'm going to retire in Belize. I mean, so there are other ways where we all could retire tomorrow and live in Kenya, right? So like, it kind of depends on, you may have to change the goal. I'm just joking, but or just even within the US, there are lower cost places to live than other, so you may have to evaluate both sides, the saving side, but also the goal side of things.
There you go. I'll probably give you a call sometime next week.
Sounds good. And another thing that's gotten better in the last 10 or 20 years, if you have equity in your home, and you're young, I can tell, but reverse mortgages aren't as bad as they used to be. So there is this idea that you don't have to die with your house paid off. It's like so. Just there's ways to get there.
Thank you, Nick.
Okay, got time for one more. Anybody?
Okay, let me offer just a couple quick closing thoughts. First of all, Nick, thank you so much for showing up today. I super appreciate it, man. Yeah.
Thank you.
And I put Nick's email address in the chat for everybody, so you can get a hold of him and he'll take care of you or point you in the direction you need to be pointed in. He's a good dude. That's why I invited him. And, I want to just say kind of one thing in closing here globally. I was thinking about this as we were going through this and listening to everybody's questions. I want to just acknowledge everybody who shows up for this thing, because this is not about how many more houses can I sell, how great can I be, whatever. This is about, I'm a stakeholder in my own financial future. And that's why you guys showed up today. And that's a really important thing, I think, for each of us to do for ourselves, so that we are able to, then help others. I mean, I've lived a life. A part of my life was we lived with my mother-in-law because she had no place else to go. She had no money, I'm not getting into her, but anyway, if I can do something to help all of us not have to end up that way, then I've done a good thing for the world. And so facilitating these calls, inviting people like Nick, having these conversations, and have no shame, have no fear. If you don't know something, ask. Sandy, I'm glad you said, look, I'm a little embarrassed. That takes guts. So thank you for leading us on that. If more people did that, you're just going to have a better future, and that's why we're here. That's why we're all here. Okay? All right, friends, again, the best hour of my week. Thanks for showing up. Invite your friends, and Nick will follow up. God bless you, and have a good weekend. Take care.
Thank you.
Thank you, Nick.